Morning, guys. So we'll be doing Komphela Limited. All right. So, as good exam technique, we know to always start with required. Okay. So it's asking us to prepare the asset section of the statement of financial position, as well as the relevant notes thereto of Komphela Limited at 31 December 2018 to comply with the requirements of IFR, International Financial Reporting Standard, IFRS. Okay, so the first thing when you're going into these type of exams is just like have your layout ready, right? So you wanna know and understand the structure of the statement of the financial position, okay? And then know your non-current assets, where you're going to put them, and then also your current assets. So you remember that your current assets are those assets that will be realized within 12 months, and then your non-current assets are the ones that will be realized over 12 months. Okay, right. So then, since they've asked us for the statement of financial position, um, you know, that there will be, because they're also asking for the notes to that, so you probably want to lay out your PPE note as well, okay? And then also just learn the structure that um, it's the carrying amount at the beginning of the period, right, which consists of the cost, right, original cost, and then accumulated depreciation up until the beginning of the period. Then you have the movements of PPE, which consist of depreciation, additions. Um, these additions, very important, is that the additions are at cost, and disposals are at carrying amount. So when you buy a new asset, it will be at the cost that you put it in your PPE note, and then when you sell an asset or trade in or whatever, then you know that it's done at the carrying amount. Okay. And then there's the depreciation capitalized. We'll get into that as we do the question, and then also the revaluation of the land. Okay, and then in the end, you've got your carrying amount, which will again consist of the cost or the valuation date value, less accumulated depreciation, which includes depreciation of the current year. Okay, so you just want to have that structure ready so that it's easy to work through, right? And you want to be in the habit of generating marks throughout the question, so such that if you don't get time to finish, then you've scored the most amount of marks possible, and you achieve that through good exam technique, which I'm hoping is what you will get from this session that we're having. Okay, right. So we'll start with the information. Okay. The following information was taken from the financial records of Komphela Limited, a manufacturing company, on 31 December 2018. Ordinary share capital is 5 million. You've got land at 1.2, buildings at cost, okay. Um, Machinery and equipment at carrying amount, all right. Accumulated depreciation of the different assets, investments at cost, loan and inventories, trade and other payables, bank, provisional taxes paid, and trade and other payables. Okay, so I mean, with the financial records, that's basically, they'll combine sometimes. Sometimes they'll give you a trial balance. Sometimes, they'll split it. I know, especially in the group statements, they like splitting it. They'll probably give you like the income statement and statement of changes in equity separately with the a statement of financial position, but that shouldn't throw you off. Okay, doesn't matter what they give you, you know that what are the components that belong in statement of financial position. Okay, and that's the information that you want. Okay, so for example, ordinary share capital of 5 million here. um it's an equity item, you know so for our purposes it's irrelevant. um it's a statement, if they asked for the whole statement of financial position, then yes, we'd have it there under equity. But because they're only asking for the asset section, you know that your um like your trade and other payables and liabilities will not be included. Okay, all right. So very important to know that. Okay. And then we have the notes, right? The additional information. Okay. So even in this layout here, you want to take note of when this information has been given to you. Okay. Because sometimes they give you like a carrying amount at a different date, because now if they say that all of this information is on the 31st of December 2018, and then they're giving you some items. So it's not all of them that are already at the end of 2018, some transactions have not been accounted for, hence why they just give you some of the carrying amounts um, before the start of the year, and then you need to factor that in via the additional information. Okay, so so Komphela acquired land situated at ERF 1234 Roslyn Tshwane on 1 January 2015 for an amount of 1.3 million. The land was revalued for the first time 28 February by Ms. Jomo, a sworn appraiser, to a fair value of 1.5 million within 4 months of acquiring the land. A factory building was completed and available for use on 1 May 2015. The cost of this building amounted to 4.8 million. On the 1st of January 2018, an office building was built on this land. The office building was completed and available for use on 1 June 2018. The total material and labor costs of the office building amounted to 1.2 million. The company withdrew its machinery and equipment from normal production for a period of 5 months during the current year and used it in the construction of the building. But the factory and office building are owner occupied. The following transactions in respect of motor vehicles took place during the year. On 1 January 2018, Komphela Limited entered into a contract with ABC Motors to lease a new motor vehicle for a non-cancelable lease period of 4 years. Starting on 1 January 2018, Komphela guaranteed ABC Motors that ABC Motors will receive a residual value of at least 300,000 for the motor vehicle. On 1 January 2018, Komphela Limited expects that it will have to make a payment of 150,000 under the residual value guarantee. On the same day, ABC Motors Limited determined that it will sell the motor vehicle to an independent party for 400,000 at the end of the lease term. So that is like the official residual value, because the residual value is something that must be agreed upon with the with both parties, So yeah, we'll just get into the detail of that a bit later when we get to this leases section. Okay. All right, and then these are the direct costs that ABC Motors incurred, and then Komphela incurred initial direct costs of 3,000 related to the lease agreement. Okay, then annual lease payments in arrears are 246,367. The fair value of the motor vehicle on commencement date is 1 million. Ownership of the motor vehicle will not be transferred to Komphela at the end of the lease term. On 1 January 2018, a motor vehicle with an original cost price of 240,000 and on which 144,000 was already written off as depreciation on 1 January 2018 was sold for 74,000. There were no machinery and equipment purchased or sold in the current financial year. Property, plants, and equipment are depreciated as follows. Machinery and equipment 20% per annum according to the reducing balance method. Okay. Motor vehicles 20% per annum according to the straight line method. All right, and then buildings 2% per annum according to the straight line method. Okay. And then investments consists of 25,000 ordinary shares in Komphela Limited, purchased at 450 per share for speculative purposes. The total share capital of Komphela consists of 300,000 ordinary shares. Each share carries one vote. These shares are traded on the JSE, and the fair value of these shares was 550 each on 31 December 2018. Okay. So, these ones are for speculative purposes, okay, carried at through fair value, through profit and loss. So we know that they come under current assets. And then 80,000 ordinary shares in Pirates Limited at a cost of 160,000. The total issued share capital of Pirates consists of 100 ordinary shares, right? So that's 80,000 out of 100,000, okay? So that means 80%, meaning that Pirates is a subsidiary. Okay. Uh, I don't like that fact because I'm a Pirate supporter. I'd rather have Kaiser Chiefs being a subsidiary of Pirates, but I didn't draft this question. Now that I think about it, should have picked another question. But that's a story for another day. For now, we'll just accept things as they are. Okay. Each share carries one vote. These shares are traded on the JSE, and the market value of the shares was 160,000 on 31 December 2018. Okay. Then we have inventories at cost, consists of raw materials, work in progress, and then just before year end, the room where the raw materials was flooded. Um, the flooding resulted in 40% of the raw materials being damaged to the extent that it cannot be sold or used. It was determined that the net realizable value of the raw materials that were not damaged was 50% below the cost thereof. The net realizable value of the work in progress was estimated to be 280,000. Okay, right. And then a loan was granted to Pirates, a subsidiary, to the amount of 132,000. The loan is interest free and is repayable in four equal installments. The first installment is payable on 31 December 2020. Okay, so you know what I normally do, okay, is that um, after having read the notes, I can already see which items are um, less complicated, okay, and I usually try and get those out the way, so start with like the easy marks first if possible. And by easy marks I just mean that like notes that are not too long, the ones that are pretty much straightforward, and then I like to go finish with some of the more complicated notes, the notes that affect more than one line item, and so forth and so forth. Okay, so here in this question, okay, I can already get going with like, for example, trade and other receivables. I know that trade and other receivables, it's got no note to it. There was nothing mentioned here at the bottom. I can take it straight to my statement of financial position over here. Okay, so trade and other receivables, 480,000. Good to go. You know. Um, all right, good to go. Okay. Then just give me a second. All right. Okay. Then I've got bank, cash and cash equivalents. Okay. Also not no notes there, nothing affected it, presented at the 18th of or the 31st of December 2018. And then I go in and I slot it in, you know. You see, I don't know about you, but for me, when I start putting in these figures, it's like I'm getting points on the board. So it's like I'm scoring. It's like I'm a striker for Pirates, you know, and I'm already scoring the goals. So I'm gonna beat Kaizer Chiefs. You know, helps with the confidence. Um, as opposed to just like going straight deep into the difficult questions and scratching my head and getting confused and under pressure, and then I forget about some of these easier things to do, so yeah, that's how I approach questions and exams. Okay, so then already like with these financial assets. Okay, so this one, the ordinary shares in Kaizer Chiefs, right? Um, you know, um, they say that these shares are traded on the JSE at the fair value of R5.50 per share, and we have 25,000 shares. Okay, so we know that when we come straight here to the financial asset at fair value through profit and loss, then we've got R5.50 multiplied by 25,000, and then boom, I've got that sorted out, done. Okay, right. Then the investment in the subsidiary. Okay, so that from because when you look at this note here, it says a loan. So a loan was granted to Pirates Limited to the amount of 132,000. Okay, the loan is interest free and is payable in 4 equal installments, and the first installment is payable in 2 years' time, right? 2020. Okay, so from your group statements module, right, that when you have like a loan in a sub, right, you're gonna have it, either depending on the duration of when it's due, you see, you will have it either under current or non-current assets, but this one is due in over 2 years. Okay, so you'll have it under non-current assets, and you probably have something along the lines of loan to uh to S. Okay, then you have like your debit and credit. Okay, um sorry, let's maybe put it in other words. You would have your loan that is sitting in your subsidiary as a payable, right? um in the separate financial statements, it will be sitting as a payable. Okay, so I mean, in the parents books, in the separate books of the parents, is sitting as a receivable, like a long-term receivable under non-current assets. Okay, so the recording of such transactions in the separate records of the parent and the subsidiary represent mirror images of the same transaction, right? As soon as the financial statement of the parent and subsidiary are consolidated, and then the group is recorded as one entity essentially, these items would then need to be set off, like those balances would need to be set off via an intergroup like journal, right? So from the perspective of at group level, you can't have a transaction with yourself, so you would then have an elimination journal, right? um, that you would then process in that instance. So you would have loan from parent, okay, um, then loan to subsidiary, right? And then that would be the, I just forgot how much it was again. 132,000. Okay. So you would have that 132,000, okay, and 132,000. Okay. So in your consolidated financial statements, there would be like this line item would not exist, right? But in the separate books, it was obviously sitting there, hence why you have to eliminate it. Okay. So yeah, that's where this elimination journal comes from, you know. So for you to see it, you know, it's just that here they just have it under one. They don't have like the breakdown of it, you know, but um essentially, you know, most of the time they'll have it separate, you know. So this investment in subsidiary would normally just be the cost, you know. So that's this investment in subsidiary is from the main elimination journal, okay, that you've probably seen so many times, you know, where you eliminate the share capital, eliminate the retained earnings, um, then you've probably got goodwill, uh, we at like whatever amounts, you know, and then you have investment in subsidiary. And then you've got your non-controlling interest, right? So in those instances, that investment in subsidiary, that would be that amount that's coming from there, this cost, this 160,000 here. Okay. Um, like okay, it's just that this one says, you know, it's carried at market value, but you know, the market value is equal to the cost at this point, right? So then that's what you would have, right? So when you're consolidating, you would obviously need to write down mark-to-market gains that would have happened, okay? But ultimately, this investment subsidiary is at cost here, and that would be 160,000, you know, at acquisition journal entry, all right? Um, Main elimination journal, okay? This is at the point which the parent acquires the subsidiary, and that's the 160,000 that we're talking about here. Okay, so yeah, that's why I was saying, you know, normally it's separated because of that reason, you know, but over here it's combined in forming part of it, with, you know, which is you know, acceptable. Okay, so then there you'd have your 160,000 plus your 132,000 of the loan. And then that's 292,000. Okay, right? Um, then we also saw the inventories. Um, there's not a lot to it. Okay, just a couple of workings. Okay, so we know that inventory is carried at the lower of cost and net realizable value. So in this case here, we see that the work in progress is 250,000 and the net realizable value of the work in progress is 280,000. Okay, so the lower of it is cost. We'll keep it there. I think I just put the calculation down here somewhere. Okay, so that's the inventory. Okay, which we will have at 250,000. Okay, then the raw materials must be at NRV, right? So the remaining raw materials we saw from the question, they said that 40% of them got damaged beyond sale, so got like zero value. Okay, so then just need to get that value, starting value was 380, right? It's 380,000. Okay. So it was, so now you say 380,000 multiplied by 60%. That's what you have remaining. And then they say this that is remaining, right, has been written down by 15%. Okay, so we times the 15%. Okay, and then the value of it is the 280 minus that 15%, and that's the value of our raw materials at net realizable value. Okay, right. Then okay, yeah, I just put a formula in there already, but it's essentially adding the work in process and the raw materials to give you an inventory value in the statement of financial position. Okay, so now we're done with the current assets. Okay, done quickly, now we can focus on some of the more difficult stuff, um so we'll then go on to like the leases question. Okay, that looks pretty straightforward. All right. So I mean, the first thing that we realized is that they didn't give us the discount rate, right? So we have to work out the implicit rate in the lease, okay, so that we can work out our right of use asset. We know that our right of use asset consists of the minimum payments under the lease, right? And then, adding obviously also the initial costs in that, to get us to, directly attributable costs and stuff like that, to get us to the right of use assets, and then that's what we depreciate going forward. Okay, so when we're working out the lease liability portion of it, right, we would need that discount rate. In this case, it would be the implicit rate in the lease. Okay, so let's get going with that. Right, so when we work that out and we calculating the implicit rate in the lease, okay, we've got at the present value, right? You see, present value of from the lessor's perspective, okay, right, is the fair value of the asset, and direct costs incurred by the lessor. All right. So we got from the question that the fair value of the asset is 1 million, and they have incurred 5,000. Okay. The directly attributable costs. Okay. Then the future value consists of the guaranteed and unguaranteed portion of the residual value. Okay. So here in the question, they gave us the residual value. Okay. So the theory is that the residual value will be equal to the estimated market value of the asset at the end of the lease term. This will enable the lessor to sell the asset for that amount, right? The residual value will be an estimate, and the lessor will not be certain what the market value of the asset will be at the end of the lease term. However, at the commencement date of the lessee and the lessor can have a contractual agreement where they agree on a residual value guarantee amount of the underlying asset at the end of the lease term. Okay, the residual value amounts can be fixed, or they can be variable, right? The residual value will be variable if, for example, the estimated market value of the asset is lower than the agreed residual value guaranteed, then the lessee will have to pay the difference to the lessor. This amount is the expected amount payable by the lessee under the residual value. So within the residual value, there's an amount that is guaranteed by the lessee. Okay. So hence why, right? The standard defines the unguaranteed residual value as the portion of the residual value of which the lessor is not assured of. So in this case, the residual value of the asset is then 400,000. Okay, right? Then the lease period is 4 years. Okay, then the payment is of the asset is 1 million, and they have incurred 5,000. Okay, the directly attributable costs. Okay, then the future value consists of the guaranteed and unguaranteed portion of the residual value. Okay, so here in the question they gave us the residual value. Okay, so the theory is that the residual value will be equal to the estimated market value of the asset at the end of the lease term. This will enable the lessor to sell the asset for that amount, right? The residual value will be an estimate, and the lessor will not be certain what the market value of the asset will be at the end of the lease term. However, at the commencement date of the lease, the lessee and the lessor can have a contractual agreement where they agree on a residual value guarantee amount of the underlying asset at the end of the lease term. Okay, the residual value amounts can be fixed, or they can be variable, right? The residual value will be variable if, for example, the estimated market value of the asset is lower than the agreed residual value guarantee, then the lessee will have to pay the difference to the lessor. This amount is the expected amount payable by the lessee under the residual value. So within the residual value, there's an amount that is guaranteed by the lessee. Okay. So hence why, right? The standard defines the unguaranteed residual value as the portion of the residual value of which the lessor is not assured of. So in this case, the residual value of the asset is then 400,000. Okay, right? Then the lease period is 4 years. Okay, then the payment is I think at the top there it was 246,367. All right. 246 246 3 sorry 246 367. Okay, right. And then the interest is what we'll have to work out, which is rate. Okay, then it wants the period, which is full. I just got it in Ransdale, correct just now. Okay, then the payment, then the present value, then the future value, beginning of the period. Okay, this should be in percent, right? Okay, so it's 12%. Okay, but in the solution they got it to 1 decimal place, which is 1%. Okay, then this over here can just be doesn't matter. But anyway, this is just a number. This is like 4. Okay, representing the number of years which the lease is active for. Okay, all right. So then we'll get to now the present value of the minimum lease payments, which is the liability, which forms part of the right of use asset. Okay, right. So in that instance, okay, see the right of use assets shall consist of the amount of the initial measurement of the liability, lease payments made at or before the commencement date, less any incentives received. All right, incentives or payment made by a lessor to the lessee associated with the lease or reimbursements, initial direct costs incurred by the lessee, so like, I mean, all of those costs that are necessary to like conclude the lease generally will form part of the right of use asset. Okay. So in this case, we just have the one expense of 3,000. Okay. So we'll put that in there as well. Okay. So very important that the future value here, okay, is only the guaranteed portion, so this is what um the what Komphela said they're going to guarantee. So Komphela said um Komphela um on 1 January 2018 expects that it will have to make a payment of 150,000 under the residual value guaranteed. Okay, so that's like the obligation, so that's how much they are willing to pay for this. Okay, so it's 150,000 that they'll pay. Okay, period is also 4 years. Okay, the PMT is the same as that, right? Then we work out the present value. Okay, um, which will be formula PV. Okay, rate is that percent over there, the implicit rate that we worked out. Then the period of the lease. Okay, then the payment. All right, then the future value. Okay, and then these payments are made at the end of the period, and then boom, we've got our liability. Okay, lease liability. All right, so you know we would need to now work out the right of use asset, which obviously includes the directly attributable costs that we discussed earlier. Okay, so that would be that 845,000 plus 300,000. Okay, then remember that right of use asset is depreciated over the lower of the lease period and the useful life of the assets. Okay, so the lease period is 4 years. That's what we have over there. Okay, then the carrying amount will obviously be the cost less the depreciation for the period, leaves us with 636,000. Okay, and that's then the amount we have there as the right of use asset. Okay, now we're left with PPE. All right, so over here we've already generated quite a lot of marks. Some of the things are straightforward. You see, yes, some things will be easier for other people. I mean, especially when it comes to things that like very well. I think the main idea is to like start generating marks as quick as possible. You know, there's always like these curveballs in accounting exams. That people tend to get stuck there. People tend to get obsessed with those. So So yeah, very important, okay, to not fall into that trap, and then put the other marks at risk. Okay. Right. So we know that this land was acquired in 2015, as the question said, at a cost of 1.3 million. Okay. Then we know it was valued for the first time, and it's the valuation date value is 1.5 million. Okay. Um, Therefore, the revaluation of this land will be 200,000. Okay. So we are at the PPE note now. Okay. And we've done the land portion, you because it was easier. Okay. Um, then we saw that the the building part, there's a building that they had. Then there's also another building that was constructed. So what I normally do in that case, when I see that there's a company that was, when there was a machine or some equipment that were withdrawn, I normally start with that equipment, so that I can get the portion that must be capitalized to the asset. So we know from IS2 that the cost of the inventory, the cost of the asset is made up of the labor and the material, right? And direct production overheads. So overheads will obviously, include, depreciation of some of the equipment that was used within the production of that asset. Okay. So in our case here, it was for a period of 5 months, so we need to um, get the depreciation of that equipment. All right. And then they say that this equipment um, depreciates at 20% per annum according to the reducing balance method. Okay. So starting here, they give us the machinery carrying amount at 540,000. Okay. Then they say the accumulated depreciation is 120,000. Okay. So come back to our note. All right. They said the carrying amount that they gave us is 540,000. Okay. Then we need to, and then they say accumulated depreciation at the beginning of the period is 120,000. This means that um, the cost, right? Because cost less accumulated depreciation is the carrying amount. So to work backwards to get to the carrying amount, we need to say accumulated depreciation plus the accumulated depreciation plus the carrying amount will give us the cost at 660,000. Okay. Let's just move this here. Okay. All right. Then the depreciation of this, okay, since it's the reducing balance method, okay, is multiplied by 20%. Okay. But since now we want to split the depreciation with the depreciation capitalized, okay, then we need to apportion this for the amount of, or for the period where it was not being used to construct this asset. And that is a period of 7 months, right? So 7 out of 12 months, this asset was not producing was not being used to construct the building. Okay, so that gives us 63,000. All right. Then for the period that it was, we then take the carrying amount multiplied by the 20%, then multiply that by 5 out of 12. And that's how much was capitalized. Okay. All right. So let's just put that there, get the signs right so we get the correct total. Then make this that plus that. Okay. And then this was the depreciation for the year, which is also need to add the accumulated depreciation. Right. That gives us 432,000. Okay. Let's just copy this formula across. Okay. Right. Now we're done there. Okay. So then we can go on to the factory and the buildings, you know. But for me, the motor vehicles is a lot easier. Okay. So I can go there as well. Okay. So the motor vehicles, they say this is the cost, 720,000, and then motor vehicles cumulated depreciation is 336. Okay. Motor vehicles cost 720,000. Okay. Then we've got cumulated depreciation, which was 336. Okay. Let's change that sign there quickly. Right. So carrying amount at the beginning of the period was 384,000 Rand. Okay. So then there was an asset that was sold, right? There was a vehicle that was sold with the original cost price of 240,000, and on which 144,000 depreciation was already written off as at 1 January 2018. Okay. So they have not accounted for the depreciation of this asset that was sold. Okay. So we know that we need to get to the carrying amount of the asset being sold, right? So again, it's like over here, okay, the carrying amount of the asset being sold, right, is what we need to work out here in the note. Okay. So how do we work that out? All right. We know that the cost of this asset, okay, was cost of this asset was 240,000. Okay. Then accumulated depreciation was 144,000. Okay. So then motor vehicles are depreciated at 20% per annum according to the reducing balance method. Okay. So now we add, just come here so that you just see the numbers. Okay. So that is the 240,000, which is the cost. Okay. This is the 144,000, which is accumulated depreciation as at 1 January 2018, beginning of the year, right? We know that it gets depreciated on the straight line method. So when an asset gets depreciated on the straight line method, you can simply get the depreciation by multiplying it with a cost, which is different from the example we did now on the machinery. Remember the machinery, that 20% gets applied to the carrying amount of the asset at the beginning of the period. When it's straight line, it's 20% on the cost. Okay, just remember that. All right. So then we have 240,000. Okay. Then we also multiply that with the period for which it was in use for, right? So in this case, since we sold on the 1st of August, right, means that this asset was in use for, again, 7 out of 12 of the period. Okay, so that is the depreciation that we worked out. So cost minus accumulated depreciation minus depreciation until the asset was sold gives us then the carrying amount of the asset. Okay, right, and that must be a negative because it's going out. Okay, right. So then we would then need to get so now, since we know that the cost of the asset that was taken out, right, was 240,000. Okay, so to work out the depreciation of the motor vehicles, okay, would then be the remaining assets, okay, plus this asset here that was disposed of just for that portion, just for that period. Okay, so to get the cost of those assets, right, we will first have to say, let's put it negatively and say that 720,000, okay, minus 244,000, yeah, is it 40 or 44? 240, sorry. 240,000, which is the cost of the asset that was disposed. Okay. Then multiply that by 20%. Okay. So that's the depreciation of the remaining assets for the current year. Okay. And then to obviously remember that cost of the asset, we'll just do it again here so that we just emphasize it, right? We will then add, okay? So we're adding the depreciation of this asset here that we excluded, okay? So that'll be 240,000 multiplied by 20% multiplied by 7 out of 12. Okay, right. So it's depreciation for the whole year of the remaining assets, and then the assets that were disposed of, we apportion, right? So let's say another asset was purchased in the current year, right? On the same date, and it cost like 100,000, for example. We would add the depreciation or the cost of that, the depreciation of the new asset. So that would say we take that cost multiplied by 20% and then multiplied by 5/12, because that's how long the new asset will be depreciated for. And then that would give us the depreciation for the current year. Okay. But since there was no asset, we'll just need to take out the depreciation for the asset that was disposed of. Okay, so that gives us 124,000. Right. Then to come close it off here, okay, we know that for the cost of the asset, we say the 720,000 minus the 240,000 gives us the cost, right? Then accumulated depreciation wise, okay, remember we have to take out the depreciation of the accumulated depreciation of the asset that was sold. So, we only have the depreciation of the remaining assets. Okay. So, maybe at a starting point, say, at 336, right, which is the opening accumulated depreciation. All right, and then just want to copy this formula here for the remaining assets so that we see the depreciation of the remaining assets. That gets us to 242,000 Rand. Okay, let's just get my signs right there. 432,000 Rand. Okay, then I need to take out the 144,000, which was the depreciation, opening depreciation of the asset we've sold. Okay, and that leaves us with our motor vehicles. All right. Okay, so then we need to come through now and deal with the buildings. Okay, so for the buildings, all right. Sorry, for the buildings, okay, all they say is that the cost of this building is 4.8 million. Okay, so we need to work out the accumulated depreciation on that. Okay, they say buildings depreciate at 2% per annum. So the cost of the building, we've got that at 4.2 million. Sorry, 4.8 million. Okay, now put in the formula there, right? So I mean, with the depreciation for the 2015 year when it was purchased, okay, depreciated for 8 months. They bought it, they completed it, or started to use it, like they say here in the question, from 1 May 2015. Okay, so May to December 2015, the depreciation there was 64,000. Okay, then the depreciation for 2016, obviously took the cost, multiplied it by the 2% for the whole year, and then the depreciation for 2017 is 96,000 as well, right? And then also for the current year, this building was not disposed of or anything like that. So that comes up to 96,000 Rand. Okay. So I've just pulled through the formulas over here as well. So the cost, which we got from above there, then the accumulated depreciation, which is what we got there at the beginning of the period, what we worked out at the bottom, then the depreciation for the current year is what we have over here. Okay, so then the additions that we have, new building, we said that the material is labor and material 1.2 million. Okay, plus the capitalized portion, which is 45,000, right? So the additions at cost, then the capitalization 45,000, sorry. Okay. Okay, so then that to work out now this depreciation, we need to know when this was brought into use, and it was brought into use after 5 months, so it's only for a period of 7 months. Okay, so for that we then say this plus this, right, times 2% times 7 out of 12. Okay, and then we also added that to the depreciation of the old building, and that gives us a depreciation of 110,000 rand. All right. Okay, guys. So that's essentially the idea we've got over here. Let me maybe just fix the signs for consistency. Although this depreciation is capitalized, remember it's added to the cost of the building that was constructed. Okay. So over here, my cost has stayed the same. Just want to add the accumulated depreciation. So it's all consistent. Yeah. Right, guys. Let's just fix this as well to get the cost there and get the signs consistent there for you guys. All right, 6045. Okay. Then accumulated depreciation. Let's just change that sign over there. Since that was for illustrative purposes. Okay, then we have this. Put that sign over there. Right. Okay, then let's have this come plus that. Right. Right, guys. Just 1 second. Yeah. Right, guys. So that's your note. There you have it, right? Then when you combine all the carrying amounts, it comes up to 7.8 million. Okay, and that's what you have the disclosed as PPE. Okay. Right, guys. So yeah, that's how you approach a question like this. All right. Most important thing is exam technique. Okay, right, and generating marks. So when you're done with something, let it pull through across. So that we see the calculations. The calculations can be laid out differently, like you see over here, my buildings. So just have it like nicely referenced out. That this building here, working that out. Over here. And then the new building as well, I'm working it out over here, nicely referenced and everything, so that the market can know what it is that you're doing. Okay. So yeah, just post any questions that you have in the discussion forum relating to Komphela Limited. And yeah, I will get back to you guys as soon as I can. Right. Thank you.